Getting started investing can be overwhelming, with lots of options and contradictory advice. But really, the evidence and research is clear on what the best investing strategy is for most people. If you follow only 5 simple rules, you'll perform better than a majority of people. This video is about why those 5 rules are all you need to get started in the simplest and fastest way possible.
We'll start with the basics. What is investing? Let's say we have some money saved up and we want to use it for something that'll benefit us in the long run. So we buy an asset. We want this asset to give us money back either continuously over time or when we sell it later. The goal is to end up with more money than we started with. This is called getting a return. A return is defined by the percentage difference between the initial amount of money and the amount we ended up with. In this case, our return was 150%. Why invest? Getting a good return on saved money can make a massive difference in the amount of money we have. Let's say we save $1,000 each year. We can compare getting an 8% return with getting no return at all. Over a working life of 40 years, you would have 10 times more money if you got started investing rather than keeping the money in a regular bank account. Investing and building wealth will allow you to later in life spend more time and money on the things you really enjoy. Investing is not only good for your finances, but it's empowering, and more people owning a slice of the economy is a great thing. If you put your money in a regular bank account, it will grow very slowly over time. Nowadays, most regular bank accounts have a 0% interest rate. The problem is that goods and services you want to buy, like food and housing, tend to increase in price over time. If the saved money doesn't grow at the same rate or faster than the stuff you need, you'll be able to buy less with your saved money in the future. One of the reasons why investing is so powerful is called compounding. Compounding is the effect of interest on interest. Let's say we make an investment of $1,000. It's growing at 10% each year. We start with 1,000. Next year we'll have 10% more, which is 1,100. If we don't reinvest the return, we'll get another 100 each year, and at year 10 we'll have 2,000. Instead, if we do reinvest the return, at year 1 there will be no difference, but at year 2 we'll have another $10. This is the return on the previous year's return. So we only get this extra return if all returns are invested. Over time, this return will grow larger, and at year 10 we'll now have 2,594 as opposed to 2,000. It might not seem like a huge difference, but look at what happens over a longer period of time. Over 40 years, this compounding effect will award you with 10 times more money compared to if you didn't reinvest the returns. We want good returns to get more money, avoid inflation, and use the effects of compounding to our advantage. Stocks represent an ownership share in a company. When a company needs money, it can perform an initial public offering, or IPO. This is where they issue new shares and sell them to investors. In this case, they sell 5% of the company. We can also buy stocks from existing shareholders. Each share gives the owner a 5% ownership of the company in this case. Almost always when you buy stocks, it's from other investors and not from the company itself. When the company hands out money to its shareholders, it's called a dividend. The 5% ownership of this company entitles you to 5% of the money the company hands out. This is one way of getting a return. The other way of getting a return is to sell your shares later on if the company has grown, and thereby the value of your shares. When a company needs money, it can either issue shares, as we saw in the case of an IPO, or it can issue bonds. Bonds are sort of like loans. It's bought by an investor who will at a predetermined time receive payments from the bond issuer. sort of like interest. At the maturity date, which is also set when the bond is created, the investor will get the initial money back. Bonds are not as easily tradable as stocks, and most investors get their bonds by buying a fund containing many different bonds. There are many types of bonds, but mainly two broad categories: government and corporate bonds. Government bonds are issued by the government of some country. They are usually safer than corporate bonds, since governments are less likely to go bankrupt and not keep up with their bond obligations. Different types of bonds give different returns based on how risky they are. Government bonds have historically given around 0 to 3% return, while corporate bonds have been in the range of 3 to 6%. It's less risky to hold bonds than stocks. The reason is that stocks can easily stop paying dividends in bad times, but bonds have to keep up with their bond payments. Also, in the case of bankruptcy, the bond owners get their invested money back before the stockholders. A fund is a collection of assets, most of the time stocks or bonds. If you own a fund, it's like owning a tiny slice of all the assets owned by that fund. Some funds hold only a couple of assets, while others hold thousands. Different funds have different allocations of asset types, which give them different risk profiles. Having more stocks is more risky, but also gives a higher return, while more bonds is less risky, but yields a lower return. Funds are managed by a fund manager, who does the work of administrating the fund and picking which assets to buy and sell. For this work, the manager charges a fee. It's usually a percentage of the whole fund value. Some funds have more active managers who spend a lot of time researching which assets to buy and sell. These funds most of the time charge between 0.6 to 2%. Passive managers instead usually charge from 0 to 0.6%. This is because they're trying to follow the market instead of trying to beat it. They're trying to perform like an index. An index is where we have a market with different assets, and we take the average price of all of these assets. Since an index fund is just trying to perform like the index, they can just buy a lot of the different assets in the index and call it a day. That's easier than trying to find the best assets available, and they can therefore charge lower fees than actively managed funds. Other asset types that you can invest in, but they're usually riskier or harder to get started with. We do not recommend having a large fraction of your portfolio in these types of assets, but we'll mention a couple so you can get started looking into them if you're interested. Real estate is time-consuming getting started with, but nowadays we can buy funds with diverse real estate portfolios. Gold is another common asset type. Gold is not a cash flow producing asset, and it does not contribute to value generation in society. Therefore, it won't have the same long-term returns as stocks, but it can be a good way of getting some protection for times of turmoil and inflation. Bitcoin and cryptocurrencies are new types of assets. They're highly promising for building a new, more fair and stable economy. But at this stage, it's high risk, high volatility, and no one really knows where this will end up. Equity crowdfunding is where small companies or startups turn to the general public for funding. This is a high-risk investment and only recommended in small amounts. We also have options and other derivatives. This is where a financial security has an underlying asset, such as a stock or a bond, but the derivative itself derives the value from a contract on top of that asset. This is only for investors who know exactly what they're doing, not for beginners. Here's the whole lineup of other investments. Of course, there are many more out there, but these are the most common ones. Stocks, bonds, and funds are the largest groups of investments you will probably be exposed to. If we want a high return, stocks are the way to go. So how do we select the right stocks to buy? There are around 100,000 publicly traded stocks globally, of which 3,500 are in the US and around 700 in Sweden. Let's say we do some research and we pick one stock. This one seems really promising. It could go really well and we make a lot of money. Or it could go poorly, crash, go bankrupt, and we lose all our money. Most of us know intuitively that putting all of our eggs in one basket is a bad idea and highly risky. But how do we measure risk? It's usually measured by volatility, which essentially means that when the price swings are large, the volatility is high, and therefore we have more risk. When the price swings are lower, the volatility is seen as low, and therefore the risk is lower. By dividing up our money on many different stocks, we can lower the volatility while expecting the same return. The more different the stocks are from each other, the more we will benefit from each newly added stock. This means that it's usually a great idea to get stocks in different industries and also from different countries and continents. Often funds are a great place to get started. In a fund, you can get thousands of stocks spread in all different industries and parts of the world for a very low fee.
What can we expect in terms of return going forward? Looking at the history is a good starting point. We'll take a look at annual returns from 1970 to 2020 of the MSCI World Index, which is the average return of all stock markets in the world. For example, 1970 had a minus 2% return, while most years were in the low tens and a couple of years on the more extreme ends. If we adjust these numbers for inflation, the average return has been around 7% over the last 50 years.
Is it reasonable to expect the same return going forward? Let's look at the reasons for this return. Companies are set up with an incentive to make a profit. In order to do so sustainably, they have to innovate and become more efficient in fulfilling people's needs. This will never go out of style. By buying stocks, you have people working hard to build the company that you own. The only time where this might not hold true is in the case of a large-scale disaster. However, in that scenario, your investments will probably be the least of your worries. The stock market is quite a safe long-term investment, but short-term, there is more risk. An example is in 2008, where if you bought at the top, it would have taken 7 years to get your money back. One way of mitigating this risk is to invest monthly. This will ensure that you get a good average price for your investments. If you started investing monthly in 2008, it would have only taken 3 years to get your money back instead of 7. Let's look at historical return over 10-year periods. As we can see, almost all 10-year periods over the past 100 years have had a positive return. Only one period was negative. If we instead look at the returns over 5-year periods, we'll see that we have a larger fraction of negative returns, meaning that we have a higher risk of losing money if we only invest over 5-year periods. The average return for stocks after inflation is around 7% historically. If we instead look at a portfolio with 50% stocks and 50% bonds, we see that we have a lower return, but also lower risk. Now we only have 1 instead of 4 negative return periods. We can see that different time horizons are suitable for different portfolios. If we have more than 8 years until we need the money, then it's fine to have 100% of our investment in stocks. If it's 5 to 7 years, we should probably bring at least 25% of our portfolio as bonds. 3 to 4 years, it can be 50-50. And if we only have 1 to 2 years, we should keep most of our money in bonds or savings accounts. How are prices set for stocks? A stock is sold and bought on an exchange. Some people submit orders that they want to sell and others that they want to buy. The price is set at an equilibrium where both sellers and buyers are happy with the price and a transaction is performed. If something positive changes with the underlying value of the stock, there will be more people interested in buying at the current price. This surge in demand will drive the price upwards until a new equilibrium is found. There are thousands of people spending all day analyzing stocks to find those which are worth more or less than the current price, so they can buy or sell this stock to make money. This is why the market is often called being efficient. All of these analysts have already found all the bargains, bought them, driven up the price until it's no longer a bargain. For this reason, it's extremely hard to beat the market. Actively managed funds have this same problem. In order to perform better than the other funds, they have to find these bargains consistently. It has clearly been proven that only a tiny fraction of fund managers manage to beat the market after fees have been deducted. Most of them will seem successful, but random chance gives a large distribution of outcomes, and most of those who seem skilled are just lucky. Their previous performance does not predict future outperformance. So even though some of them may be skilled enough to justify their fees, it's essentially impossible to distinguish between those who are skilled and those who are just lucky. It's also important to remember that many funds are very similar. If this is the market of all available stocks to buy, we can have one fund with a high fee and another fund with a relatively low fee, but still, they own almost the same assets. Since active managers don't outperform their fees, one of the only things that we can actually do to control our returns is to buy funds with the lowest possible fees. These are usually index funds, which try to track the market. There is so much information out there regarding investments and so many ways of making money from unsuspecting people. Therefore, when you get advice, always look at the incentives of your advisor. How could their advice potentially benefit themselves, and what would the impact be on you? Here are 3 sources of advice where it's important to remember this. First, media. They always have an incentive to draw your attention and will therefore try to angle stories and make them seem more sensational, or only present the most interesting material. This is seldomly a good place to get the best information. Bank advisors don't charge you for their services, but instead they try to sell their own overpriced funds. There are good independent advisors out there, but remember that if you don't pay them up front, you are paying them indirectly by them not giving you the best advice possible, since they get a commission on the funds they sell you. The average private stock investor dramatically underperforms the market, 5% versus 10% for the market as a whole. Over a life of investing, this difference can be as large as having 10 times more money if you make a plan, stick to it, and don't let your emotions take control. So, what are the largest mistakes people make? The first one is trying to time the market. Buying low, selling high. Trying to figure out what will the market do the next week, month, or year. This might not seem that hard looking back, but it's extremely difficult doing this going forward. The usual result is that people miss out on great gains by not investing, or starting to invest when the market has had great gains in the past. Another common mistake is to panic after a large price drop and sell off all investment. The risk is that the market swings back and you've missed out on all the gains and have locked in the losses by selling. Also, following the market really closely is not a good idea. Half of all days are losing days, and you're only looking at noise. There is not really any useful information in daily return data. To sum up what to do if you're just starting out, invest monthly to get a good average price, invest long term to reduce the risk of losing money, or adjust your risk by allocating a larger part of the portfolio to bonds. Minimize fees, since there is no evidence suggesting that high fees yield a higher return. Control your emotions and set up a plan in order to not make poor decisions on impulse. Invest a majority of your money in global index funds to ensure good diversification and a solid long-term return.
Thank you for watching. Comment if anything is unclear, and subscribe if you want more videos about healthy investing and long-term wealth building.